What's up, gang? Welcome to the Greatness Machine. I'm your host, Darius and I'm so pumped to have you here with me. Now, listen, the Greatness Machine, we're about two things. Number one, people who are living their passions. And number two, those who are creating greatness in the world and doing both of these things despite the odds against them. Each episode, we're going to feature interviews with game changers, business leaders, telling us their origin stories, what made them tick, what got them to where they are now. Why? So it can help you step into your greatness within your life, your business, and your career. Occasionally, you might hear a few solo episodes from myself, moi as I say, as I leverage my 20 years of entrepreneurship as a CEO and founder to help you grow and level up in your journey to scale your life and your business. So, come be a fly on the wall, enjoy the conversation, and I'm stoked to have you here with me. Guys, welcome to today's episode of The Greatness Machine. I'm your host, Darius Mershazne, and boy, do we have an amazing guest. The one, the only, El Presidente, Phil Mancuso is in the house. What's up, Phil?
Choo-choo, baby. Oh. Thanks for having me.
I'm going to tell you what, man. I was like, I have to do a show with Phil, man. You are such an awesome human being, and you're such an expert at so many things, and I thought we'd have so much fun. So thank you for coming on the show today, my friend.
Oh, boy, you're too kind. You're too kind. The feelings are mutual, and any opportunity we have to sit around and BS a little bit and move a couple needles, how do you not be excited about that?
Oh man! So I'm gonna do a little bit of housekeeping for listeners who are new to the show. Greatness Machine is really about two things: about people living their passions and those creating greatness in the world, and doing so despite the odds. And my main man Phil here is neither short of passion nor greatness. I want to give a little bit of background because I invited you on the show for a couple reasons. Number one is Phil is one of the smartest, if not the smartest person I know in the investment world. I mean, like you really have a unique perspective on what's happening in the markets. We're going to be talking about a lot about the markets because there's so much going on right now. And but Phil, man, you're a funny guy. You're hilarious. You're super smart, and you're doing so much. The way just to give some background on how I know Phil is, I met Phil actually through my work I do coaching and advisory work, and I started working with a company in Atlanta, Georgia called Equity Prime Mortgage, or otherwise known as EPM. And so Phil's a stakeholder, and he's the chief investment officer there. He's also the president of a company by the name of Appraisal Nation. So super deep in residential finance. For listeners of the show, that we don't talk too much about mortgage, although it is an area of expertise I have. But I told Phil before the show, I'm like, hey man, a lot of the listeners here don't care about mortgage the way we do, but what they do care about is what the hell's going on in the world. And so I really wanted you to come in here just so we could talk, about what you're seeing. But before we go there, I'd love for you to give kind of your origin story, because you do have a really unique origin story. You came up in the business world through, some really interesting path, and now you're doing some amazing things. But would you mind giving us a little bit of the origin story?
I mean, we're going like all the way back to when I was 2 years old. It is a story that's pretty consistent, I think, with what you often hear. Like if you go to conferences or, speakers get up there and, we talk a lot about, walking uphill backwards with no shoes in the snow. So at the risk of having some elements like that, and the reality is on balance, it wasn't anything like that. But, I was the first person in my immediate family to go to college. That was far more important for my father than it was for me, because what preceded that was, paper route in fourth grade, sort of worked at the place to have a job in high school, a local deli, slinging cold cuts and making sandwiches that were way too fat for the owner's preference. Okay, so we're giving away the profits. That was one of the first business lessons I learned. Don't make the sandwiches too fat, but maybe you should. And saw this ad. If I kind of wanted more, saw an ad in the newspaper about making $20 an hour. This was circa Q1 1988, and answer the ad in the newspaper. And as any good promotion or ad is written, it wasn't necessarily $20 an hour. it was $6 an hour and $2 a lead in something called the mortgage business, which up to that point, I had a real interest in the financial markets and in stocks, but not really in mortgages specifically. My parents owned a house, and that's about all I knew about that, and I lived in it. So went there, interviewed, long hair, if you could believe it, 3 earrings, because was played guitar and all that other stuff, into rock and roll and heavy metal. And, it's like, wow, the money sounds great. Work from 6 to 9, 4 nights a week, telemarketing out of a phone book. And within like 4 months, I was making $500-600 a week, working 12 hours a week. And in 1988 dollars, like that could almost buy you a Lamborghini, but, and a year and a half later, summer between high school and college, I was like, hey, I think I could be a loan officer. And frankly, I think a lot of the sales you're making are because I set them up for your LOs, and the sales manager agreed. And kind of the rest is history. My first commission check was 5 figures, August of 1990. And so I cut most classes. I kind of only went to Rutgers, and I hope no one's listening, but was able to do well anyway. And I really just stuck with it for my dad because it was important for him. But the reality is, I knew what I wanted. I was sort of hooked at that point. It was as close as I could get to being a stockbroker without being one and having to be one. And I felt like this was cooler. And yeah, I've never gotten out of it since.
Man, so quick question, because as I mentioned earlier, you're chief investment officer at EPM, stakeholder there, and so I actually, it doesn't surprise me that you got your start on the sales side, just because you're a very influential and convincing person. Anyone that knows Phil knows that he is a convincing dude. But you worked your way from, that was an interesting start to the business, and so you got your start there. I actually kind of assumed that you always wanted to get on into the trading side of the business because of your mind for trading. But how did you parlay that into getting into the trading side of the business, the investment side of the business? Because that's obviously an area where you're making a huge splash right now, and in your current role and in many of the roles you've been doing, over the past 10 years. But how did you parlay sales into that?
Yeah. So from 88 to 98, it was, for all intents and purposes, 100% sales. Telemarketing into sales management, into leading sales for a company. So my passion for the markets, as crazy as it sounds, really came from movies, sort of specifically, originally Trading Places. Loved that movie, watch it at Christmas time every year, and wanted to be Dan Aykroyd's character, getting into the Rolls Royce with the butler and that was awesome to me. And that's what I wanted. But the selling side really came from the paper route and collecting and trying to get tips. And, I've said this, I believe that everybody is selling everyone else every day. The examples I've used as a child, why you should get the candy or the baseball cards. Not that anybody does that anymore. Why somebody should date you or marry you. And then once you have kids, why they should listen to you, why somebody should hire you. So I believe that sales runs through us and all of us almost every moment of every day. Somebody's either selling somebody or being sold. So that part was really, I think, a fundamental part to understanding business. But always keeping an eye on the markets. I've tried to be opportunistic. And so in that regard, my first really, really, really big break, with all due respect to some of the other positions I held before, was at a company called Parkway Mortgage. They were a subprime lender at one point, bigger than the Money Store and Champion. a sort of little known fact, company started by a guy named Brian Moran, who's no longer with us, but awesome guy. And probably the second influential guy in my mortgage career is a loan officer named Bill Carroll, who I shared an office with, who kind of took me under his wing. And Bill and I were two different guys in terms of how we sold. He sold more blue collar people. I sold more white collar people, and we'd riff off of each other. But Senior, I really looked up to, again, very similar background, sort of, blue collar background, and, kid made good in the finance business, household finance back in the day when there was such a thing. And how that happened was one of the jobs that led to this point for about a 6-month, 1-year period I was an LO at that company, loan officer at that company, had left. And then this new thing called DU and LP came about, which was, for those of you who don't know, that was automating the approval process for a mortgage.
Right.
It was revolutionary at the time. And being this young kid gamer who, sort of Pong to Coleco, to Atari, to ColecoVision, to computing, I wrote some, basic code, built computers. I was a very early adopter of this new thing that most people resisted. And, just long story short, it allowed you to do loans that you otherwise would traditionally not be able to do. People who couldn't qualify. Some crazy things, really stretching the boundaries. And I don't want to get too technical, but Darius knows what I'm talking about. Just some crazy loans. And so did this for a couple of years, became an expert in that, at a time where you kind of had to go through a vetting process just to use it. And folks, if you're not in the business, that sounds crazy today because just everybody uses it. It's ubiquitous. And so I called a branch manager at one of the offices and said, hey, there's this new thing, and you guys aren't properly monetizing all of your leads, because anybody that has a credit score over X, that basically gets thrown out. You're only selling people with low FICO scores.
Right.
And I think we can monetize it, and further, we can make more money on those loans than you're making on the risky loans. Because this is 98 when we had a subprime liquidity crisis.
Right. So that's what long-term capital blew up in 1998. So to your point, like that was and for people that don't know, that was like the '08 Lehman blow up before the '08 Lehman blow up. It was a massive, it almost took down like the whole world economy, right?
100%. It was that was the first '08, if you will.
Right.
And so spoke with Brian's son, who we used to call him Senior and his son Junior, sort of affectionately. He was totally into it. And we ran this pilot program out of a branch, and we closed a loan with an extremely high debt to income ratio. And I got a call one day from the second in command. He says, can we really sell this loan? I said, not only can we sell it, I already have a takeout, and we're making triple what you would normally make on a risky loan. He's like, when can you come down to meet with us? In Kenilworth, New Jersey. And if anybody knows the movie Glengarry Glen Ross, that's in Kenilworth, one of the scenes.
Oh, no way.
Yeah. So I'm like, I don't know, it's your company. You tell me. And the rest was history. We created a product called Premier Plus. Senior didn't want anybody to know that this was a conventional loan. So the best subprime loan on the matrix was Premier. I said, well, let's just call it Premier Plus. And we'll call it Make Sense Underwriting. But in reality, all it was all the loan officers and offices would send us scenarios that I had three people who were processors key in and get an approval.
Got it.
And then
so you guys
we'd send out a pre-approval. We were the most profitable part of that business for 8 months. And so that's how I started to transition into cap markets, because I had to run the cap markets side.
Right.
It was sort of a business within a business.
Got it. Okay.
and ran the cap market side of it. When I sell, I would always sell as a loan officer in the financial markets. This is what rates are doing. This is what you could do. But actually doing it, it started then.
Oh, I love that, man. So this is so for listeners who have they're like, why are they talking all this mortgage speak? Basically, like for a non-mortgage person, you saw a gap in the market that you could take this new technology and basically do loans that traditionally, just so everyone understands, when you get a mortgage, people just key in your information into a system. They press go, and it goes into another system that says approve or don't approve. And that's what Phil's talking about. He's talking about the system that gave you a thumbs up or a thumbs down. It's automated through technology. Back in the day, a human being would read that application, manually decide if it met the rules or not, and would give you a thumbs up or thumbs down based on the rules. So this was a massive change. This is why there's so many more people who are able to buy homes now than 20 years ago, because you have the ability for a computer to make that decision, for better or for worse. But I didn't know that about you. So you parlayed that. That was your introduction to cap markets. Do you mind explaining for a listener that has no idea what capital markets is? What is capital markets?
Well, I mean, I don't even know what it is. No. So, it's, I mean, could I distill it down to it's sort of the transference of the appraisal and transference of money is kind of what I would, from my perspective, what it is. So if you look at it from, say, a standpoint of stocks, well, how do we value what a company is worth, right? I may see that value is different than you might see it and so forth. And then how do you and I, in a matter of speaking, wrestle around our perceived value of that company? You might be the buyer of the stock within that company. I might be the seller. I think it's worth X. You think it's worth Y. We have this price discovery that occurs within the market to sort of determine that. And that's influenced by current events, the interpretation. All of this is in my opinion, the interpretation of an interpretation of an interpretation. It's not this gray area of what things are worth based on supply and demand, based on market conditions, based on what any individual thinks, feels, or believes at any moment in time. And it's based on commodities, stocks, bonds, a whole host of things.
Right. So what's funny is, before I was in mortgage for a hot minute, and then I got out and became a stock trader. I don't know if you knew that about me.
I did not.
I traded equities for about a year for a Wall Street firm and they had an office in San Francisco. So that was actually why I moved to San Francisco, was to take that job. Let's put it this way. My third day on the job was 9/11. So it was not a good time to be a trainee in a stock trading program. It was a really bad time. I made no money, which is why I got back into mortgage, because I was like selling loans. I was telemarketing loans on the side to make ends meet. But what I heard you just say was essentially like capital markets. There's a market making aspect, right? Where you're trying to sell the asset and make, bid asks, you're the bid or you're the ask, depending on what you're doing with the asset. And you're trying to find a buyer for the asset and maximize profits in the process. I love that you got into it through sales, because that just shows, how entrepreneurial you are, that you were selling, you see the technology, you then start selling these loans on the secondary market, at your business. And the rest, I guess, as they say, is history. And so you ended up working your way into a company that was actually at one point the largest subprime lender in the United States, the Money Store, and from there MLD, and then from there parlayed that experience into your current role as Chief Investment Officer at EPM. Are you with us?
I am. Yeah.
Oh, sorry, your video went out. So we're gonna have to edit this out. The part out that Sid, edit out from where I just cut off into right now. So parlayed that experience into a really big role into a stakeholder and chief investment officer at EPM. I'd love for you to talk about like right now. I feel like we're in this spot, and I want one of the biggest reasons I asked you on the show is I love talking economics. I love talking markets, and you know, for anyone that's listening, we're going to put Phil's social handles in the show notes. You need to go like follow Phil on social. You're doing this thing called Mancuso Minute right now that I want to talk about that in a little bit, but I want to fast forward to, you know, over the last 10 years, you've worked your way into this huge role and into probably one of the fastest growing, you know, lenders in the United States. You know, what do you think when you see right now the markets as they stand today? When you kind of look back over the last 10 years, how are you feeling about what you're seeing? Because I have so many thoughts, but I'd love to hear your thoughts on this.
Yeah, and I'm pretty passionate about what my thoughts are, so happy to engage on that. Let me give you 2 bits of information before. So the technical definition of capital markets is the part of the financial system concerned with raising capital by dealing in shares, bonds, and other long-term investments. So isn't my definition so much better than that? And
way better.
I say that to sort of segue into the answer to your question, because I believe that business and the markets are a living, breathing thing, not a static thing, which sometimes we try to distill it down into. For probably more like the last 20 years. So 2002, if I could start my answer with 2002, as we start using more and more automation as an industry and as and you know, just a general society, a business ecosystem, I feel like that we begin to really sow the seeds of what you're seeing today, of the 98 and then 2008 and then 2014 and Brexit 16 and then sort of the COVID collapse, which most people will sort of blame on COVID. I actually called that in a recorded networking sort of session in August of 18. I said, look, there's going to be a crisis driven by the overvaluation of mortgage MSRs and student debt. It just so happened to be that COVID was the match. I believe that was happening in 2020 anyway. And what I believe we're about to get into here sometime in the next 12 to 18 months. And so what it starts with, from my perspective, is not in the numbers, not in capital markets, not in anything other than a fundamental understanding of what's driving the world. And I believe that that's information and automation. And what you'll hear me say ad nauseum is that information and automation are wage and price killers. So when folks say to me or anyone, rates are low, they're historically low. Not many people are saying that right now. Everybody's crying about where rates are. But then you'll also hear me say, well, rates are never going up.
Right.
And again, hard to hear over the last 6 months because rates have gone up, but not in the historical sense. I go back to saying my very first computer cost about $4,000 in 1982. You can go out and buy a computer for $300 today. So in that regard, don't talk to me about inflation, right? But if we talk about the cost of a watch or a Lamborghini or a house, then maybe there's massive inflation, right? But then again, over the course of a 30-year period, maybe there isn't. I look at it and I say, folks today know more than ever what things cost. When they cost that, how they cost that, if they go on sale, and the efficiency in the consumer is breathtaking. The example I always use is my grandmother wanted a gallon of milk in 1955. The household didn't have a car. She could, she'd have to walk somewhere, most likely the corner store. If they wanted to make 300% on a gallon of milk, they could. She had no choice. She wasn't going to walk 10 miles for a gallon of milk. Now, if I want a gallon of milk, I boop, beep, bop, boop. I've got 100 vendors from all over the globe that could deliver that gallon of milk. And potentially deliver it faster than what it would take me to walk to the corner store.
Yeah.
Or in today's day and age, get in my car. But even if I get in my car, I could drive an extra 5 miles faster than she could walk a mile.
Amazon now, baby. Right? Like coming right at you.
Coming right at you, like a freight train. So in that regard, what I believe we've seen materialize over the last 20 years, minus a period after COVID where the supply chain was so disrupted that people were willing to spend some extra money, is the shift of the game of chicken between buyers and sellers. Sellers won for a millennia. All of a sudden, the buyers started winning that game of chicken. Wait a second, I'm not going to pay this price because it's going to go on sale in 3 months. So if you don't have price elasticity, you can't have high interest rates. If you don't have high interest rates, you sort of have this perpetual growth in businesses. That's why the stock market has sort of taken off. So I look at what is happening in the markets from a very basic standpoint. Are people doing better today than they were? Are the prospects of a job better? Is information and automation going away? And how do I trade the market around those very simple terms?
So let me ask you a question. I love where you've gone with this. So I had a guest on the show who wrote a book called The Price of Tomorrow, which it's a bit of a doomsday book, and he got a lot of national play for this. Smart guy, entrepreneur out of Canada, and he has his thesis is essentially that, and there's truth to what I'm about to say, and you just said it, is that technology is deflationary in nature, right? And so to your point, like I remember when my parents, we're close in age, and I'm a Gen Xer, which means that we are of the generation there that first got VCRs, right? You use the example of the computer. I'm going to use the example of VCR. I remember with the VCR, I think my parents paid $1,800 in like 1983 for a VCR, which in today's dollars is probably like $7,000, right? $6,000. So anyone listening, they're like, "What's a VCR?" If they're a millennial, but it's a thing that you would watch movies on, which was a big deal because you could only watch movies in the movie theater. The families then were paying $6,000 in today's money to be able to watch movies at home. Whereas today you spend $19 a month for unlimited movies, right? Or not even $11 a month. I guess Netflix would love to get $19 a month from you. But so technology is what is deflationary in nature, right? There was a point in time where VCRs were $100, and then there was a point in time where you get them for like $50, right? But when they first came out, that's what they cost. So he made a couple points. His point was that technology is deflationary in nature, and that Miller's law. I think it's Miller's law. Is that the Moore's law? Moore's law, excuse me. The speed of technology, it doubles every 18 months, right? Which comes from the speed of a microchip, how much it can store, how fast it computes. And he said when you combine those things, you get an exponential increase in the speed of technology. And he said most people can't imagine, they don't have the mental fortitude to really understand what we mean by exponential growth. And he uses the example of you fold a piece of paper 50 times, that the 50th time it's the thickness from here to the sun, right? And which is kind of a hard thing to fathom because we as humans don't think exponentially. And he has a lot of concern that basically automation, AI, all these things are going to completely get rid of jobs. There's going to be no jobs like unless you have a very special, like you're cutting hair for a living, right? Or these jobs that are very bespoke every single time, that essentially that we're going to have massive deflation. And that was his concern. He's like, look, there's massive deflation coming, like you've never seen before. And so I got off the call. We did a show, and I was like, man, you just made me sick to my stomach. Because he's like, stock market crash, all this stuff. You hear Andrew Yang talk about stuff like this. So these are guys who are on the far extreme of some of the stuff you're talking about. But I'd love to hear your thoughts on given what you said and given what I just said, what does that mean for the inflation of assets? And what does that mean for interest rates? Because we're in a time right now where, to your point, short-term interest rates have gone up a lot. The Fed's talking up rates like crazy, trying to be hawkish. But I mean, I was on a call yesterday, 2 days ago, with an investment banker who I believe you know as well, and it's funny because he was like 10-year 4%, right? And I was like, maybe. And I know you're a 10-year 2.2% guy. So give me your thoughts on the deflationary nature of do the markets have real risk of deflation? What are your thoughts on that? And then also, like, why do you think that interest rates are low forever? Because I've heard you say that before, and I appreciate it, but I want to understand it better.
Yeah. So first things first, I don't think that those thoughts are extreme. I frankly think that they are spot on. Questions that I ask is, again, very simple concepts. Self-checkout. Why do we have any cashiers anymore, right? If you understand how businesses operate and the efficiency with which they try to aspire to, if self-checkout didn't work, they would have abandoned the experiment. So the existence of self-checkout suggests to me that it works, right?
Right.
The question is, okay, now what's the next step? Why are we afraid to go full self-checkout? Are we concerned about, are there sort of, and I'm not meaning in the Illuminati way, although I have to say, on Instagram, I got a message saying that I'm now in the Illuminati. I've been invited to the Illuminati.
Oh,
so I'm excited about that. It's going to
nice.
be me, Jay-Z, and Beyonce. I haven't sent the money yet, though.
You're part of the Clinton cabal.
Yes, yeah. But or the other example I've used is toll collectors. I mean, Easy Pass works, Sun Pass works, right? So why do we have any toll collectors? So I do think we can go very dark very quickly in that regard of there are hundreds of jobs. I don't mean hundreds of individuals, hundreds of jobs that exist today that are already obsolete given current technology. Why we haven't made them obsolete yet is curious. That's the thing where I'm waiting for somebody to maybe wake up. Step two in my maturation, to tie a little bit of a bow on this, in cap markets, came around 2002. I was concerned that Home Depot would wake up one day and say, hey, let's get into mortgages. Because some quant would say, we make 83 cents on every customer. Imagine if we offered all of our customers a mortgage and I could take that from 83 cents to $800, which would be massively underpricing a mortgage, but obviously parabolically growing their margin per footstep in their business. So that's when I said, hey, I've got to take the cap markets for MLD to another level so we can sort of compete and get ahead of the curve. So at the end of the day, part of what drives me in business, quite frankly, Darius, is not knowing what the heck my kids are going to do for a living in 20 years. Because I think that if you're not a musician, if you're not an athlete, if you're not an artist, if you're not a chef, if you're not an electrician, a plumber, a tradesperson, what are we going to do? What are you going to do? I mean, heck, there's automation around the obsolescence of bartenders. So I do think in that regard, I wonder how many jobs will be left in 20 years, which is massively deflationary. Now, I had spoken with a supply chain expert that says, and we talked about computers and VCRs, and what her supposition is that we have this insatiable appetite to consume here, particularly in the United States.
Specifically, yeah.
Yeah. So I grew up with basically one television, one car, later became two cars. I think in our house now we have, 12 TVs, which in aggregate, roughly cost less than that one TV that we had.
Right.
And she surmises that we're going to go back to that at some point.
Oh, wait, she thinks we're going to go back to a less consumption-based economy.
Correct. So
I have a question for you on this, though. So finish your thought, but let me ask this question because I don't want to lose this.
That's the only way that I'm wrong about 2% interest rates versus 4% interest rates is if we go back to few expensive things rather than many cheap things.
Yeah, you told me this was the woman from Deloitte, right?
No, I think it was Goldman Sachs.
Goldman, my bad. We talked about this at dinner a few months ago, but
yes.
Okay, so I'm going to throw a different thought, which maybe she's right, maybe she's wrong. So I was in Mexico over the summer. I went there for 1 month. Okay, I lived in Mexico for 4 weeks, and it was a city I've been to many times. It was Oaxaca, Mexico. I got married in Oaxaca, Mexico 15 years ago. Okay, in October. So, and I'd been there in 2004, which was 3 years before I got married. I went there in 2007 when I got married. I went there again for my wife's aunt's 50th in 2019, and I went this summer. And I told my wife, I said, it's interesting. People are way more tattooed now than they were before. And I'm going to make a point. And I said, they were more tattooed than they were 3 years ago. Like everyone was tattooed. And I said, you know what? The world's way smaller with Instagram. People see the way, and this is an American thing, right? Where people want to look more like the American pop stars, and we kind of are the leader of cool, right? So I took that one data point, and I'm going to give you another data point, and I want to hear your thoughts on this. And we have not talked about this because I really am dying to hear what you think. So the other thing that's very American is self-storage. 90% of all self-storage is in the United States. And why is that? To your point earlier, we consume more than we can handle, and people need to put their shit somewhere, right? So if you look, so why is that an American, like, why would Americans be the only people with self-storage? So I asked myself, so I put those two thoughts together, and I said, okay, will the trend go in the direction you're talking about, or will the trend go in the other direction, which is if we are exporting American cultural attitudes and beliefs, if that is happening through media, and now the world's smaller because of the TikToks of the world, and now the world's smaller because of Instagrams of the world, my actual belief was, are we then, now I do believe that an automation of menial jobs will undermine this, but let's assume that doesn't undermine it. Will we also export our consumerism to the rest of the world? Because if we do that flies in the face of what that woman thinks. What are your thoughts on that?
Yeah, I think that's a great point. One of the principles, so I have several underlying principles for why I think rates are never going up, one of which is the automation and information being wage and price killers. I have some interesting wage stats that I want to share with you. So I'll put a pin in that. Let's make sure we come back to that. One of the other things that I said was sort of the proliferation of the MTV Cribs era, which now social media is MTV Cribs on steroids.
Totally.
Okay? Where I believe that was a huge contributor to our consumption. Why? And I've used this as an example. My father growing up in the 50s, Mickey Mantle is his idol, right? His baseball idol. You heard, but you didn't know that Mickey Mantle's hanging out at the Copacabana, drinking, champagne and eating fancy dinners, driving around, in a Mercedes or a Cadillac or a Rolls Royce, living in a mansion. You sort of assume these things, you understood what the wealthy in America sort of probably looked like, acted like, lived like, but it wasn't in your face. Okay. Now, all of a sudden, you're invited into their living room.
Right.
Master P with the gold-plated ceilings. And you say to yourself, because this is sort of human nature, why not me? Why does he have that? Why does she have that? And I don't. Well, the simple answer is that you don't make $60 million a year or whatever. Okay. So what I've sort of surmised is, how do I recreate the Mickey Mantle, the Master P, the Kim Kardashian lifestyle? I don't have the wallet for it, so I pick and choose my spots. It might be an iPhone, which I just bought the new one. I got the purple one. I'm on the plan. So it's 7:57 Eastern. We were in there. We got our phones. But so you see, I can only substitute my in generalizations, my lack of wealth on a relative basis to the elite, the famous, the uber wealthy that I'm watching driving Bugattis and everything. I could just do that by stretching my dollar. Step one of stretching my dollar is just be super cheap. Hey, I'm going to wait. I'm going to buy on sale and all this other stuff. So I think that's been a driver in a lot of the deflation over the last 20, 30 years that we've seen. Is that
why is that? I don't follow.
Because the aspiration to a lifestyle that we can't afford on average. So we hold out.
Oh, okay.
To get it. It's that game of chicken.
Yeah. They used to, when we were kids, you used to be able to do rain checks, right? Where you'd which I don't think anyone, if you weren't born before 1985, you have no idea what I'm talking about. Where literally I'd go buy something, I'd put it on hold, and then wait till I had money to buy it, right?
Yes.
So same idea.
So the Fed right now is getting killed about saying inflation is transitory. I think that the mistake that they've made is capitulating on that thought. It is transitory. We're already seeing it. We could talk about the analytics around inflation and how about CPI is lagging and imperfect. But I want to read to you a very interesting or an interpretation of a chart that I'm looking at. And for those of you that might be interested, there's it's www.weforum.org, and you can find this. It's called A Long-Term View on Wages in the United States. And it's real hourly earnings adjusted for CPI. Or hourly earnings adjusted for CPI, which gives you real earnings adjusted for inflation. So from roughly 1994 to what looks like, 1964, to what looks like probably 1968, about a 4-year period, real wages went from $20 an hour to $23.24. Again, it's adjusted. Okay. That wasn't what people were really making.
Right. Adjusted for inflation. Maybe it was $5 an hour then, but that would be the same as making $24 an hour now.
Exactly right. Okay. Seasonally adjusted, blah, blah. You put all these adjusters on it. So it went from $20 an hour, slightly below, to $23.24, February of 73 is actually what it's saying, right? It then goes all the way down to below $20 from a period of roughly 85 to 95. Okay. We get back up above it. We don't reach 23.24 until March of 2019. Wow. So, Darius, I want you to think about this, right? It took us roughly 10 years, 8 years, whatever I'm sort of extrapolating from this imperfect chart, to see the same growth in real wages that it took about 40, almost 50 years to experience from 1973 forward. Okay? What are the implications in lifestyle? And that includes the go-go 80s, for the record, right? The implications of that, I think, are massive in terms of how households behaved economically, how the how we consume, what the future looks like. We're probably the first generation where our kids don't do better than the previous generation.
Yeah, I agree with that.
How is any of this inflationary in nature when you consider, again, real wages in March 2019, the same as real wages in February 73? The answer is it can't be. And so why did the Fed think inflation was transitory? Why do I think rates are never going up? With the caveat, do we have another supply chain disruption? Do we totally eliminate oil and force gas prices up, right?
I don't see it. I think what's happening in Europe right now. So I saw a thing this morning saying that the Belgium minister came out and said that the next 5 to 10 years, because of their dependency on Russian oil and because of their dependency on eco-friendly energy, are going to be brutal from an energy perspective. So I actually think that that's a great case study for that. The world's not ready to be 100% green, because when it's winter, wind farms and solar doesn't work, right? And so you need kind of
they can't charge their electric cars in California.
Oh, right. Yeah. You just took, I was just going to go there next. It was like California, they just sent out a notice saying, don't charge your electric cars. So look, like fossil fuels in a better, more eco-friendly format are probably here to stay, but they're not gone, right? To your point. So yeah, I think that you made a great, I 100% agree with you. I have a question though, because what we're talking about here is that real wages have stayed flat for 50 years, more or less, down to flat, right? And this is this is probably more of a political conversation, which I don't want to get into, which is, the corporate earnings have never been better. The real worker has not done better. And there's some societal risks there, right? We've seen this in Rome, and we see this in, Byzantine Empire. And you look at these, like if the average person's not doing better, they sure as hell can't be doing a lot worse, or else you're going to have some societal issues, right? But talking about that, I think, and I'd love to hear your thoughts on this, is if you look at that time frame, especially over the last 20 years, the biggest difference I would say is that you just exported a ton of jobs and essentially exported a recession overseas, right? Through our debt and through our manufacturing, right? And so if that happened, right, that's how we kept the cost of goods low, because China started making more stuff, and India started making more stuff, and Vietnam started making more stuff. And I'm experiencing this where, I have team members in the Philippines that do some work for us, and I have team members stateside, where you'll see as more of these jobs move overseas, then their wages go up. And then you start saying, well, shoot, if I'm going to pay this much for overseas, I'll just keep it here in the States, right? I think we're at this really interesting crossroad where we've done a geographic arbitrage for wages for the more, repetitive jobs, right? We have had an exponential increase in technology, which speeds things up. And that's one of the driving forces for keeping real wages low. I've heard, and this, so let's just assume that those. I don't think anyone's going to argue that that's kept real wages low. I heard Elon Musk say his biggest concern for the world, and this is, I've been waiting to ask you this question, is he thinks depopulation. And I heard a guy who has a book out right now, and I'm forgetting the name of it. I'm trying to get him on the show, where basically he's saying that you saw it happen in Japan. We're seeing it happening in China now because of their one-child policy. That depopulation, people are not having kids. Like there's tons of people that don't have kids now that would have had kids 20 years ago. That you have a depopulation issue, and that is actually inflationary in nature. And then you couple that with people don't trust just-in-time supply chain like they did pre-COVID, and that you may see a huge macro shift back to localized manufacturing with less of a population, and that we actually have inflationary forces at risk here. So I'd love to hear your thoughts on that, because that flies in the face of some of the stuff we're talking about.
Yeah. So it's tough to talk about this without it appearing to be political in nature, right?
Right.
So here's the El Presidente disclaimer, right? I think the biggest mistake that we make politically, because we sort of personally choose a side, is discounting that both sides are out for one thing, and that's generally themselves. Okay.
Power. Right.
As Eddie Perez likes to say, there are no saints in the room. So there are no saints in that political room as far as I'm concerned, right? In a lot of ways, I feel like all of this is one big Ponzi scheme. Okay. And so whatever side we're on, there is a risk of somebody pulling the plug out of the drain, which then shifts this conversation massively in a direction. You know, the social media is such a huge component of this conversation in from my purview. To take it back to economics for a second.
Wait. Why did you just say that? Why do you think social? Is it because of the dissemination of information that people get access to these ideas?
I think it's sure 100%. But what ideas? See, because once you're in the algorithm, if you have an idea and I have a similar idea, all I'm going to get is you feeding me my idea and me feeding you your idea. We sort of become brainwashed into thinking either A, everybody thinks this way, or B, there's no other answer other than our answer.
Right. So it's a confirmation bias, to your point.
Yeah. And I feel like we're so quick to want to label everything and everybody. And that's one of the dangers of social media. And you talk about Elon Musk, and like one of the things that he said was, you know, if you look at one of his memes or whatever the heck you call this stuff, is like, you know, he argues he hasn't moved politically. You know, it's just one of the sides has had a massive shift, and he's still where he's been, but it gives the appearance that he's moved to the right or what have you. And so that's one of the ways that I think that how we consume content and what our mindset is, you know, is dangerous in regard to how we continue on this path to globalization. I mean, my father owned an embroidery business that ultimately closed because of globalization and automation. And it was really the combination of those things. The business got moved offshore using cheaper workers and more technology. So that was like sort of a double whammy, so to speak. You know, what I'll say about that is, in the least political way possible, we have become more independent. My read on what information, whether it be social media or otherwise, has done to us, our society at large, is we've become more independent. We've also generally become more cynical and skeptical. Okay. So what I think that's helped to do is it's helped to push sort of procreation a little bit further into the future.
Right.
And or sort of, you know, I've made that less the thing to do. You know, I mean, what did you do 50 years ago? You got married, you had 2.3 kids, a dog, a white picket fence. Those ideals don't have as much legs as it used to. So
do you think it's because of going back to your comment before, that real wages have been flat and it costs way more money to have kids?
100%.
Yeah. I think it's an economic issue.
I do think that we are more selfish as a society, you know, and I've said that. That was that, and that sort of completes that Master P gold-plated ceiling Mickey Mantle thought. is I think on balance as individuals, we're a bit more selfish, that why isn't it me sort of thing. And so
Right.
if you delay consumption, if you delay having kids, if you delay being married, you can have more. That is absolutely an underlying component of it, in my opinion. Now, whether we've been groomed to think that way, and that's where you could go dark on this, or whether that's just been sort of the unintended consequence. Some people blame Mr. Rogers. Everybody's special. I'm special. They blame him for setting us on this course.
Not like when we were kids. Oh, actually, he was big when we were kids. But maybe our parents, we were latchkey kids, so we were watching stuff by ourselves. The next generation got the participation trophies. I think we were the last generation to deal with corporal punishment. That we got to bring back corporal punishment, because that'll fix all this.
It'll fit. Hey, a good fresh one. There's no substitute for it.
Watch your mouth, or I'll smack it. So sorry. Finish your thought.
Yeah. So. To talk about cap markets, there's no absolutes. No one knows absolutely what is going to happen. But from a probability standpoint, I think the idea of we're going to become more European in our consumption rather than the vice versa that you present, I think that's a less likely outcome. That's number one.
Less likely that we become more European, or less likely that everyone else becomes Americans?
That we become European.
I 100% agree. I think everyone else becomes Americans.
So now here's the question. There's a difference between a slowdown in the growth of population and an absolute outright depopulation. Okay.
Fair enough.
So again, I think that depopulation is a potential outcome, but a less likely one. Okay. So now you say, all right, if we're more likely to consume globally like Americans consume, if we are less likely to depopulate, if we are more likely that information and automation continue to proliferate, then that is deflationary. Period.
Deflationary because I understand if population does not fall off, if the rest of the world consumes per capita like Americans. When you look at these numbers, by the way, we consume like 3x everyone else per capita.
Yes.
For one of us, we buy 3 times the amount of shit that other people buy. So if everyone else starts buying 2 or 3 times what they're currently buying, how is that deflationary? Because that's demand. That increases.
We don't
demand.
have the money. So let's go back to that chart and this begins to sort of complete my thesis. So the Fed says inflation is transitory. Why? Because they know what I know, right? Or knew what I know, or what I surmise, if you will, which is, if you look back 1990, you look back 94, you look back early 2000s, late 90s, you look back, through 95, and up through COVID stimulus. Our booms for the last 30, maybe even 50 years, if you believe that chart, versus the 50, 60 years that preceded it in America, in the industrialization expansion of the United States, first expansion, then industrialization of the United States. Those booms were driven by wages, were driven by earned, sustainable income, save the Depression, okay?
Sure.
So I made $1 yesterday, I made $1.10 today. I can spend it. I have real disposable income. And I'm optimistic about the future. Our country is growing. Our economy is growing. I'm likely to make $1.20 tomorrow. So I'm going to get that house. I'm going to get that car. And we, in some respects, fake it till I make it sort of thing. That's sort of how we behaved for the first, 4, 5, 6 decades of the 20th century. And then all of a sudden, here comes automation. Not in the way we know it, but it started in the 60s, right? So now my dollar doesn't go as far. What created the booms? Well, number one, more money was inherited in the early 90s than at any point in the history of the United States. Pop. Dot-com boom. Housing bubble. Intra-year tax cuts. COVID stimulus. Guys laugh at me a little bit. I'm on a couple message boards, and we're affectionately calling this the Gucci index. So when I moved down here to Florida, there's a mall in Orlando called the Millennium Mall. Really interesting mall. It has the highest of the high end, and then just sort of like your everyday mall. So you got your Gaps and your this and that, and then you have Hermes and Chanel and so on. And in between, you kind of have Gucci. We moved down here, and dude, there's a line not out the door, but almost out the mall for the Gucci store. And what's the correlation to that? COVID stimulus. Okay.
Right. Well, hold on. What you just said, and I don't want to undermine this, but when you go back to what you're saying before, 1950s, I'm making $1.10 versus $1.20, and I'm optimistic. I was going to say, and you just pointed this out right now, and I want to tie those two together. Was we saw that happen the second people got stimulus checks? Was everyone started buying like crazy because they had an extra dollar. And I will tell you this, and you may have seen this in the business that you've owned and ran. I did not realize how many people live paycheck to paycheck until I had I had 1,000 employees, and I started seeing it if we had, like we moved the pay period to a Monday or something, the uproar. And I was just doing it because it was like an administrative thing that made sense, or that our pay fell out because of the calendar, not like to do it in a bad way. And I was like, this is crazy. And then I noticed the minute I would give anybody a raise, these are people that are not making a lot of money. These are people maybe going from $50,000 to $60,000 a year, right? This is not someone that's super wealthy. Right away, they went from a Honda to a Beamer. And I was like, what the fuck? I remember thinking this. I'm a guy driving a Volvo. I'm the CEO of the company, and I'm seeing my $60,000 a year employee driving a car more expensive than mine. And so I remember talking to Ali, my business partner, who and I said, wow, man, people spend every cent they make. And people will spend every cent they make and then some. So sorry, you just set that off for me.
No, so dude, it's 100%. So now, fast forward to 6 months ago. Okay, about a year later, no line, none. It's gone. We were talking about interests and so on. Watches are one of my interests. Go on Twitter and just sort of, or Instagram probably better, and just sort of search Rolex and consume some Rolex Patek Philippe or Richard Mille content, right? And I know that, people are like, well, who the hell buys $1 million watch? I get it. But probably the gold standard for my example is Richard Mille makes his Bubba Watson watch, which Bubba Watson, the golfer, could wear on the golf course, one of the longest hitters, and it could withstand all those G forces, right? And it's made from carbon fiber. Retail price on that was about $108,000. Those watches were going for $500,000 as recently as March or April. They are down below $350 now. Still ridiculous, right? But that's how quickly it's happened. Why? Bitcoin, all the Bitcoin billionaires, crypto goes to shit. They were all on margin. I talked about that 4 months ago. I was like, what happens when all these guys who are trading stuff on margin start getting called?
Right.
They were, and so I want to talk about that, about what's driven this current economy, as well as I have an opinion on that. But when you consider, if you understand the economy, and I keep saying the Fed is treating the symptom and not the cause, and why they called inflation transitory, but now they've capitulated on that, is because they understand that all of our bubbles have been driven by transitory situations, inheritance, low rates, a surge in housing, a surge in stocks, intra-year tax cuts, stimulus, okay?
Right.
The difference in those things and wages is wages persist. Those things, when the money's gone, it's gone.
Right.
Either when you spend it or when it goes down, when it's gone, it's gone. And so the wealth gap, okay, when COVID hit, and I sent an email to the company, it was either the May report for April or the June jobs report for May. I don't remember. But I sent an email to the company and I said, this is going to be a skewed K recovery. And what I meant by that was, and I'm not using scientific numbers here, so just indulge me for a minute. But you have the so-called 1%. Coming into COVID, universally, we called it sort of the 1%. And so let's say 1% of the population, was making over 400 grand a year, or whatever the number is that we use. And let's just say 20% of the population was really struggling in the U.S. economy. What I surmised would happen, and I would argue has absolutely been the outcome. What I said was the 1% is going to become about 10 or 15%. And the 20% is going to become 30 or 40%. What we've done is we've consistently squeezed out the middle class, the so-called middle class.
Right.
Okay. So I believe what we have right now is the 1% has become 10 or 20%. The bottom 20s become 30 or 40%. That middle percentage, whatever that might be, when you do the math, 40%, 30%, 50%, they're in a slightly worse position than they've been, especially and absolutely if their house or their 401k has gotten hit. Maybe less so if it hasn't. And I believe what the market and the Fed is being tricked by is by the 20% or that 10, 15%. Because ultimately, they're not the ones that have ever moved our economy. It's the sort of the so-called rank and file. It's the everyday American that moves the economy. So you bought a slightly nicer house, a slightly bigger yacht, a slightly more expensive watch. That blows the numbers out. But that doesn't create real sustainable inflation. One of the guys, Adam Quinones, like we affectionately call him AQ, like he and I will sort of argue. He insists that there have been demand pull inflation, which means demand has brought up prices. I am not sold on that because demand of what? Half the output? That's not real demand.
Mm-hmm.
The one thing that I admittedly got wrong was I thought that the cheapness, and I've called this, it became chic to be cheap. In the 80s, it was like, oh, guess how much I paid for this Rolex? That'd be this Mercedes. Then it became, oh, guess how much I paid for this? It became chic to be cheap. I thought that was with us forever. And just the convergence of the sort of Kardashian internet and no supply got people keeping up with the Joneses a bit more than I thought would happen, admittedly. But there's a limit to that, and we've seen that. We've seen what's happened to every metric. It's dry. We are seeing, I believe, massive deflation in a lot of asset classes right now that we're being fooled by saying, well, because we started high. I don't know what that means. Lower is lower.
Yep. So on that note, and I know I scheduled 90 minutes with you because I knew we would be talking a lot, but we got about 10 or 15 minutes left in the show. I do want to kind of hit on like where we're at right now, right? So you're talking a lot about the Fed getting it wrong. You're perpetually out there on the Mancuso Minute saying perpetual, rates are low forever, right? So I'd love, right now, 10 years, 3.31, 6 month treasuries are in the threes. We have this spike. The Fed's talking up interest rates. I'd love to hear where you think rates are at 12 months from now and why, and where you think the markets are at 12 months from now and why.
I am absolutely resolute in thinking that there is going to be a Q1 23 rate cut.
Whoa, really?
It would be February if there was a meeting in February. I don't necessarily. At times they will do an intra meeting rate cut, so maybe it's March. There are a lot of different reasons. Too many, really. So I'm going to oversimplify it here. Not the least of which is understanding, and I have this on my slogan, that figures lie and liars figure. Okay. Understanding how the data works. Now, number one, we know that prices started to massively appreciate around this time last year. So one of the reasons we have 9% inflation, let me just digress for 1 second. Rick Santelli, who I watch, I generally don't love CNBC. I used to just keep it running on mute, and then I'd see Rick come on and I'd listen. And he brought up one time, and I've said this before, there's like sort of almost no such thing as a wrong call. It's a matter of time. So this chart's a buy, this chart's a sell, this chart's a buy, this chart's a sell, sort of, right? So is there inflation? Is there not inflation? Is there deflation? I don't know. What period of time are we talking about? That is part of why it's so difficult to get it right, or when you're right, maybe you're wrong, or when you're wrong, maybe you're right. So if prices started going up last year, okay, well, then of course we're at 9% inflation year over year. If we started from zero and we're here, of course prices look gaudy. But what I was talking about in one of the one-on-ones I was with yesterday with some of our brokers, it was sort of like I'm in the process of starting to sell my house in New Jersey. We're definitely here permanently. I haven't been up there. I haven't been in the house since we moved down here. But I will likely sell that house for less than it was worth in 2005. Still.
In real dollars?
In notional real dollars.
Gotcha.
Adjusted for the renovations I did and everything, I will lose money on that house. Okay. But let's just say it's worth 20% more than it was last year. What does that really mean? Let's take the house I bought here in Florida. I paid 20% less than the last two owners. Okay. Let's just say, for argument's sake, it's worth 40% more now. That's what sort of Zillow would have me believe. By the way, it's worth much more than what Zillow is saying because we did a renovation, and I probably won't get my money back 100% on everything I did there too. So all of this is a bunch of funny business, funny baloney anyway. But anyway, let's just say that it's worth 40% more than I paid for it. Well, that's just from my purview. Let's say the original owner still had it. So now it's only worth 20% more than it was worth in like 2012. Well, in 10 years, 20% is, we'd expect it to be worth more than that.
Way more.
Should be worth 30, 40% more. So part of this notion that there's massive inflation right now and why I say the Fed is off sides is because it's old news. And we started from zero. Okay. So now you look at it and you say, what's the cost of lumber? Lumber went through the roof. It's back down to pre-COVID levels.
Right.
What are we doing about that? What are we talking? Why would elevated new home prices persist if the supplies that go into building that home have come back to earth? They probably won't.
Right.
I think I saw a stat saying that 90% of the houses that are being sold right now are going for under ask. So
under ask, and the other thing that I'm seeing, and for listeners, that you may do this if you're trying to buy a house, is, or they're keeping it the price and then they're giving credits towards the lending because of the lending environment, which is it's a hidden way of lowering the price essentially, right? So yeah.
Gas has come down massively, but I think we get obsessed with the price of gas because I paid less in 2008 than I'm paying now, and I paid more in 2003 than I paid yesterday. That's sort of an artificial thing that I feel like at times we put a bit too much weight on. I feel like that, other than in times of extreme, it has a more incremental impact on the price of things than we sort of give it credit for.
Right.
So at the end of the day, the Fed should have raised last August, right, should be arguably easing now, or at least neutral. We're tightening in an inarguable recession by historical standards. If you look at, aside from seasonal adjusters and the fact that I don't completely believe any of these numbers, not because they're made up, but just because of how they're, calculated and correlated. But the ISM reports in Q2 and early Q3 have largely been not great. I'll say it that way. This ISM services was okay this week. So I would almost argue that we're probably looking at a negative third quarter. And then my question then becomes, and here's where this is probability, not definite or what have you, is if we do experience 3 negative quarters in a row, does Q4 become negative just because the first 3 were? And it's like, well, holy shit, we're in a recession. I better not spend. And what I've observed is the seasonality of interest rates on an intra-year basis. Usually rates start coming down in December around that Fed meeting when they kind of have a little bit of an oh shit moment. Because Christmas season, I put a lot of weight on Christmas. And what I look at in terms of an underlying economy, if you were only going to spend money one time a year and you celebrated Christmas, it'd be Christmas because you want your kids to be happy. And so when Christmas season doesn't go as we've expected, which has pretty much been the last 20 Christmases, what is that really telling me about the consumer?
Yeah, I love it, man. So 10-year, 12 months from now, 2 point, is it in the 2s?
Yeah, I mean, it's for sure in the 2s. My number has been 225. That's sort of my bogey. Would not be shocked if we were sub 2. I think we're in real trouble, dude. Real trouble. Okay. Because again, the internet, the efficiency of it. Why would you pay if you know that something was worth less today than it was yesterday? Why wouldn't you wait? The same way, like this inflation that we've had, it was sort of speculative, and it was like, well, it wasn't that I'm willing to pay more. I believe that this started not with, I've got boatloads of money and I'm going to spend it. That's what real inflation is when you don't value your money. I just want it. Fuck it. I don't care what it costs. It started with, I'm afraid that it's going to be worth more tomorrow. Boom, I want it. Now it's ending with, I'm afraid it's going to be worth less tomorrow.
Yeah.
So
which that by itself is deflationary ideology, right? Like people believing that that is going to hold off on demand.
Yes.
And to your point, that microeconomics, demand goes down, supply stays up or flat, price goes down.
I am Darius. So strategically, and I don't do my own stocks other than I have like a stash account that I have a couple bucks in that I'll play with. It's a pretty neat app if you've never used it. It's like, it's cool. And
Stash is the name of the app. Okay.
Stash is the name. Yeah. Well, because it's a stash.
Right. Yeah.
Yeah.
I love that.
So my guy Frank, I mean, he's already started to pull back. We're going to probably pull back further here this month just to let things marinate a little bit, right? And then go back into stocks at the end of the year. But for me, I am a holder or a seller right now of almost everything except housing. And I'm going to tell you why. And here is where, money, David Lee Roth said, money can't buy you happiness, but it could buy you a boat to pull you up right alongside of it. Okay. So, we have this slogan, hashtag lives, not loans. And I've sort of even taken that a bit of a step further when I said it's called, homes, not houses. Right? Home ownership, not house ownership.
Yeah. A home is way different than a house.
A home is way different than a house. You can't put a price on your happiness. We don't know how long we have left. My father, as I said, owned a business, and it was great until it wasn't. And for a long time, it wasn't. And always talked about retirement. Always talked about tomorrow. And he never got to see that tomorrow. Okay.
Yep.
And so that really, look, you can't sell out your future for today. I'm not advocating that either. But what I am going to say is I live for today. And I live for being happy. I live for my family. I live for my kids. And I've really been beating this drum about using social media to sell housing, to get people to understand when they wait what they're missing out on. That holiday morning, that Thanksgiving dinner, that backyard barbecue, that throwing the baseball or the football, or we live on a golf course right now. Being able to go out at 5:00 with Thomas, and hit a couple balls, or even though Nick's not a golfer, he plays baseball, watching him go out and hit a 350-yard bomb if he happens to catch it on the club face. And I started doing that content on Saturday mornings, and on the weekend, we're doing golf content. I get like 12, 15,000 views on my golf content in the first hour because people like, hitting bombs. So we're going to do Bomb Squad baseball and Bomb Squad golf. Just go out there. We have a lot of pros that belong here and just like do videos. And like, I walk around there and we're like, choo choo. And, and so it's sort of like, even though I do think it's likely that your house will be worth slightly less tomorrow than it's worth today, why put it off? If you're not happy where you're living right now, or you would be happier elsewhere, fuck it. Don't talk. The shame of 2008, the criminality of 2008, in my opinion, was all those strategic defaults, right? And I argue your house is worth your car is worth less the moment you drive it off the lot, other than during insane COVID where used cars are going for more. Your credit card debt, there's no collateral there. People are having difficulty monetizing their education. I'd argue that's sort of wasted money. So could you monetize those dollars better? Why are we obsessed with the monetization of our home? Sure, an investment property, I get it. Start living your life today. Live it to the fullest. Live it like it's your last one. We make those pizzas in the backyard, or Thomas helps me pick out a bottle of wine. We have friends over, or tonight we're going to the lounge, with friends and bring a bottle of wine. That's what we do it for. My buddies, I hadn't seen them in a year and a half. They came down here. We're out there drinking high noons, hanging out by the pool, drinking Kona Big Waves, which is my favorite. It doesn't have to be expensive, by the way. It's just making hamburgers and drinking beers.
Yeah, man.
I couldn't do that in New Jersey as fun as we did it here because of the weather. You know, I don't know.
Yeah, I love it, man. Like ending on the home ownership tip. Man, what a pleasure having you, Phil. I mean, I'm telling you, man, I knew we would get to go down some cool rabbit holes, and I had high expectations, but you exceeded my expectations, which are tough to do. So thanks, man, so much. Look, you have some really cool stuff going on social. Where can people connect with you if they want to learn more about like the markets? Because you have the Mancuso Minute that you put out every day. You're putting out a ton of stuff on golf. We didn't even talk about golf. Like Phil's in it with some of the most amazing golf pros in the world. But you have some really interesting content and pizzas and galore. I mean, we could have done a 3-hour show talking about all that stuff, but maybe we'll do another show. But yeah, where can people connect with you if they want to see some of the content you're putting out?
I think the big one, and we've really put a focus on Instagram. So where you get to see sort of the most content, the most diverse content from me is on Instagram, elpresidente_EPM. We do some content on LinkedIn, of course. That tends to be more business-like, although I'll post a picture of a steak in a David Lee Roth, a Van Halen lyric. And that gets some good traction because I'll try to tie it in with current events. So on LinkedIn, it's just, whatever, Phil Mancuso, you can find me. We're going to start doing TikToks. And, I'm going to really branch out. I'm going to be doing wine, cigars, golf, because you mentioned we have Patrick Reed and Sam Horsfield, and I'm friends with a bunch of others. When he's around, Danny Willett or Charles Howell III, DA Points, a bunch of other guys. So we're going to be doing some real fun content. I'm a big Yankee fan. We did something from the Trop. We went to go watch a Yankee game. I'll be doing stuff with the kids, like I said, with the hitting bombs on the golf course and on the baseball field. And I'm going to be doing stuff with Max, my dog, because who doesn't love dogs other than maybe cat lovers? Probably do some stuff with my wife. Relationships are I joked when I moved down here, I'm bringing 1984 back.
I love it.
Relationships have always driven my career and my business, and why should now be any different?
On that note, you guys go hug your kids, go drink some beers, eat some pizza, hang out, make your house into a home, and go follow elpresidente_EPM, because I'm telling you, Phil's content is fucking nails. Phil, Mr. El Presidente, what a pleasure having you, my friend.
And question everything. Eyewitness economics. Just don't believe everything you see. Go to the mall and ask, how's things going?
Yeah, I love it, man. Thank you so much for being on the show, Phil. Appreciate you so much.
I really appreciate it. Thanks, buddy.
All right. Peace out, everybody. Till next time.
You are listening to The Greatness Machine, and that's a wrap for today. Listen, if you love what you heard, subscribe to the show on whatever podcast platform that you're tuning in on so that you don't miss any of our future episodes. We have tons of great people coming on, and we're stoked to have you here to enjoy it with us. Leave us a review. Tell us what you love most about this particular episode. We love getting the reviews. We love to see what you guys love most. And if this particular episode, made you think of someone who's leveling up in their business and in their life, print screen, share it with them. Leaders are the best givers, and after all, we're all here to support and grow with each other. And in case you want to see some of the fun behind-the-scenes shots or some of the things that we're doing, I'm actually writing about this in my weekly newsletter. Go to www.therealdarius.com and subscribe to my newsletter. We're talking about fun things like business and life and mindfulness and cryptocurrencies and, gosh, I don't even know, everything and anything. But it's tons of fun stuff I write about. I try to get it out on a weekly basis. You can subscribe at www.therealdarius.com. And with that said, look, thank you guys so much. I appreciate you. I love you. Peace. We're out of here. See you guys on the next one.
She's my lover.